Assalamualaikum and a very good day to all viewers out there. Today we're going to discuss question final exam FAR270, question 2 from exam December 2019. So let's look at the question first. It's question 3. Question 3 is on MFRS 108, which is equivalent to IAS 8. Which is on accounting policies, changes in accounting estimates, and errors. So let's look at part A of the question. The statement says accounting policies are the specific principles, basis, convention, rules, and practice which are applied by entity in preparing and presenting the financial statement. So basically the statement is trying to say that this has something to do with recognition. Accounting policy is about how you recognize, recognition, something to do with measurement that is guided by various standards, either measurement during initial measurement and during subsequent measurement. So that is the whatever rules or basis or convention or practice that were in the recognition principle and measurement, and where that is being applied by the entity, which is the company that prepare financial statement, when they actually try to prepare and present the financial statement. So you are asked to state the differences between each of the following ways of applying the changes in accounting policy. So changes in accounting policy, if you were to do accounting treatment, applying the changes, you can either adjust it retrospectively, retrospective application, or prospective application. So what you are asked to do there is to state the difference. What are the difference between these two application or the two adjustment? So remember, they are either adjusted retrospectively or adjusted prospectively. So accounting policy is adjusted retrospectively. What do we mean by that? We are trying to apply the new policy, because we say changes in accounting policy, apply the new policy to transaction events, any events, any transaction, and condition, as if the policy has always been applied for. The policy has always been applied for by the company. That one is giving you 2 marks, right, for that part. And then the next one, you are asked to talk about the prospective application. What is prospective application? Just now we talked about retrospective application. Retrospective application means to apply the new policy as if the transaction or the event has always been applied for. So let's say you have this situation. So this is your current year. This is your future year. Let's say current year is 2020 this year. Next year 2021. So let's say this is prior period or prior year 2019. So when we say retrospectively, we are adjusting it to the earliest possible period, as if that has been always been applied for. When we say prospectively, this one is retrospective adjustment. So you adjust where change start to take place. If you talk about prospective adjustment, what is prospective adjustment? Prospective adjustment has something to do with applying the new policy. So we are talking about prospective adjustment or prospective application. It's the same thing, application or adjustment. What does it mean? It means that according to the MFRS, you are applying the new policy. The new policy here refers to the new policy in recognition, measurement, presentation and disclosure, right? You are applying the new policy to the financial statement, that you are preparing, of course. You are doing that of not only the current period, not only the current year, of the current year, but you will still continue to do so in the future year. So you're going to do it also and future year or future period is the same thing. Future period. Future period. So that's the difference between the two. Where for retrospective, you try to go to the earliest possible years where the change in accounting policy took place, as if it has always been applied for. Whereas for prospective application, you apply the new policy starting from current year, and you will continue to apply it in the future prospectively. So that was for the first part. Let's look at the second part of the question. Second part of the question is about a company called Harvey Berhad, where you have the information here of Harvey Berhad. Let's see what we have here. As at 1st of July 2018. 1st of July 2018 is the beginning of the current year. The retained earnings balance in the books of Harvey Berhad was 2.5. So meaning that this is the one that stood in your statement of changes in equity under the retained profit column, retained earnings, 2.5. So this is the retained profit brought forward. During the financial year ended 30th June 2019. So this is the end of current year. You have the internal auditor of Harvey Berhad that had identified the following situation. Number one, the company had acquired and recorded a machine on 1st January 2019 at a cost of 300,000. So there was a machine being purchased, right? And you have recorded it correctly, 300,000. However, that was on 1st of January. This is an important date. That is trying to tell you that if you talk about the beginning of current year is 1st of July 2018, it ends somewhere 30th of June 2019. And if you say 1st of January 2019, this is still in the current year or current period. I put here current year. So 1st of January. However, there is a transportation cost. The transportation cost was 1,000. And this transportation cost was treated as revenue expenditure. So this is something that you need to focus. So you cannot treat transportation cost, which is a directly attributable cost, which is the cost of bringing the machine from its place that you bought and to your intended location. That shouldn't be treated as revenue expenditure. So this is wrong. And this happened in the current year, right? So the useful life of the machine is 10 years. 10 years. So you have now treated transportation costs as revenue expenditure. So there is some error, misapplication of the accounting policy, and this is an error actually. And this is the error in current period or error in current year. And because of that, depreciation charge of 12,500 was already recorded for that year. So because of that revenue expenditure that was wrongly treated, yeah, it should be a capital expenditure. Your depreciation was also somehow being an error. So this 12,500 was also another error. Why another error? Because you have understated the depreciation, since you only may have calculated the depreciation based on the initial cost of 300,000, right? Whereas you should have added the machine, the cost of transporting the machine of 1,000 to the 300,000. So the another error here is that the depreciation was being undercharged. Yeah, undercharge. Okay, that was the error in the current year. So that was actually the requirement of the question, which is requirement B, which is to state whether it is an error, yeah, or is it a change in accounting estimate, or is it a change in accounting policy. So you need to do part A. So we have already actually done part A here. So we go to the second one. It was discovered that the company had overcharged a credit customer with sales amount of 30,000. So you have overcharged your customer. Maybe the bill should be less by 30,000, but you have already issued an invoice asking for their payment extra by 30,000. So this is another error. But since this happened on 1st of January 2018, yeah, so which is happening in the prior year, it happens in the prior year, because our current period is 1st of January 2018 up till 30th of June 2019, right? So therefore, if this happened on 1st of January 2018, this is what happened in the prior period. When I say prior period, means not in 2019, but this happened in maybe somewhere before 2019, which is actually here, 1st of January 2018, 6 months before the beginning of the current year. So therefore, this is a prior year error. So that discussion will give you an idea of answering the part A of the question. Next, the company purchased a plant costing 400,000 on 1st of July 2015. So I erase all this. So let's see just about that. So I'm using red just now because those are about error. So when error, we normally mark them as red something, which is alarming, right? So we'll be doing that. Now we go on to this part, which is not an error actually. Company purchased a plant costing 400,000. You purchased a plant, and that was on 1st of July. So this is the date of acquisition, and this is the initial cost that you have acquired, right? Cost acquired 1st of July. And you are informed that it was depreciated on straight line basis. So it was depreciated on straight line basis. And cost was 400,000 1st of July. So that is purchased on 1st of July 2015. Cost is 400,000. and on this date the estimated useful life of the asset is 10 years, and you adopt straight line method. Nothing wrong. And then starting from 1st of July 2018, meaning that within this 3 years gap, 3 years, yeah, due to heavy usage, the estimated useful life has now changed from 10 years, now changed to being revised to 5 years. So a change in estimated useful life, a change in depreciation method, a change in the percentage of depreciation, these are all changes in accounting estimates. So this one is changes in accounting estimates, where from 10 years now becomes 5 years. So because of that, there will be a change in your depreciation charge for 2019 on 30th of June. So the cost is still the same because they adopt straight line method, so depreciation is charged on costs. So this is what you need to see, is that what is the effect on the depreciation. Will that reduce the depreciation or will that increase the depreciation? So this one is relating to changes in accounting estimate. Only that for changes in accounting estimates, you do not have to adjust retrospectively, you need to adjust prospectively. Adjusting prospectively means just to apply that changes, which is the changes to the useful life from the date 1st of July 2018 onwards, meaning that in 2019 go forward 2020 until it is being fully depreciated. So we have already answered part A. We have already answered part A just now, which is just to state or determine. You don't have to go and explain. You just need to say the first one is an error in the current period. The second one is error in the prior period. The third one is changes in accounting estimates. So let's look at the next part, which is asking question B. B, ascertain whether the application in the above situation should be adjusted retrospectively or prospectively. So if you look here, you are to mention whether should there be a prospective adjustment or retrospective adjustment. So earlier you know that under your situation 1, it is a prospective adjustment, prospective application or adjustment, because there was a current error in the current year. Situation 2, it will be a retrospective adjustment, because that one, it has something to do with prior year error. Situation 3, that one would be a prospective adjustment. Why? Because that is changes in accounting estimate. So you are done with that.